Are you wondering how you should be constructing a portfolio for retirement income? The reality is that each individual retiree's portfolio should be constructed based on their own unique circumstances. Some of the building blocks will be similar, but how they're arranged is going to vary very much from person to person. In this video, I'm going to describe the 4 core attributes or 4 criteria that we need to be considering when constructing retirement portfolios next to other income sources. I'm going to walk through some examples of what each of the different investment products are that satisfy each of these criteria. And then I'm going to close the video with some examples to illustrate how these different investments and criteria can be applied to retiree situations in real life. But before we start, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I put together this channel to share ideas and concepts that I'm using to help Canadians with their retirements every single day. If you want to get more videos like these, consider subscribing to the channel. And if you have any questions or comments, please drop them below. So before I jump into the 4 criteria, I want to give credit to Daryl Diamond, who wrote the book Retirement Income Blueprint. The list of criteria that I'm going to go through in today's video actually comes from Daryl's book. It's one of the first books that I bought when I decided to focus my practice on retirement income planning. And if you're interested in finding that book, I'm going to include a link in the description below. It includes a lot of really good information about tax planning, estate planning for retirees, retirement income, investments. It's a great resource, and if you're interested, I encourage you to check it out. So now let's set the stage for what we're trying to accomplish with retirement income planning. And in my opinion, what we're trying to do with this type of planning is create a steady stream of income in retirement over an uncertain amount of time, and a retirement that has a lot of variables that are going to be thrown into it while we go through the course of our retirement. And what I mean by that is, we know for sure how much money we want to have coming in every month, but sometimes life throws us curveballs. We think and we hope that we're going to live long and healthy retirements, but sometimes it just doesn't work out that way. So we're planning to experience, or we know we're going to experience, these sort of variables and uncertainty in retirement, but we want that retirement income to be certain. We also want that retirement income to be able to support us in that second and third decade of retirement as the cost of living increases. So it leaves us in this situation where we need to combine certain asset classes with some other uncertain asset classes and combine them together in such a way that it fits the retiree situation and accomplishes the goal of creating that stable income over a 20, 30, even 40-year retirement. So now what I'm going to do is I'm going to talk about the 4 criteria or attributes that I believe each retirement income plan should include. So the first attribute that we want our plan to include is an element of certainty. And certainty is a lot like what it sounds like. It's having asset classes and income sources that are stable and you know that are not going to go down in any circumstance. The income can cover a short period of time in the event of like a short period between maybe say retirement and when we want to begin collecting Canada Pension Plan and Old Age Security, or it can be a certain and stable source of income that's going to last you throughout your retirement journey. These income streams are unaffected by changes in interest rates. They're unaffected by fluctuations in equity and bond markets. They're reliable and you know that they're going to be there no matter what. Financial products and income sources that satisfy the certainty criteria are things like Canada Pension Plan, Old Age Security, income annuities, private pensions, and even guaranteed income certificates. The second criteria that we want our retirement income plan to satisfy is the probability criteria. Here we're describing assets that have the probability, but not the guarantee, that they will rise over time and outpace inflation. Here we're taking on more risk in order to get higher expected future returns. In the short and medium term, we know and need to be prepared that investments in this bucket are going to fluctuate in value. And for this reason, any withdrawals that are made from these types of assets need to be revisited on an ongoing basis to make sure that withdrawals are not outpacing the ability of this bucket of assets to create income over your entire retirement lifetime. Financial assets that satisfy this criteria and then go into this probability bucket are things like equity funds, bond funds, fixed income funds, and real estate investment trusts. The third criteria is flexibility. And in this bucket, we want to hold assets that allow us to respond to life changes when life inevitably throws us curveballs. Those curveballs can be positive things. Let's say you want to make a large gift to a child or a grandchild, or something like a negative situation where you have a health situation come up in retirement and you need to have some dollars set aside that you can respond to that. Or let's say that you have something happen at your house. Maybe you need a new roof put on your house that you didn't necessarily plan for, and you need to have some money set aside for that purpose. To assess how flexible our assets are in retirement, really it comes down to the question of how quickly can this asset be turned into cash that I can use toward the need that has come up in retirement. And the other criteria is for any asset, once we own it, does it give us the ability to change our mind and change it into something else down the road? Financial assets that satisfy this criteria are things like simple cash, just having cash on hand for an unexpected expense. Equity index funds and fixed income index funds are flexible in the sense that you can quickly turn them into cash. We'll talk a little bit about that flexibility in a moment. That's not an asset necessarily that I would put at the top of my list for my flexible assets, but technically you could convert those to cash fairly rapidly. The third asset class or financial asset that I might include in the flexibility category is something like short-term debt. So maybe a home equity line of credit that you take out right before retirement. In the event of a large emergency, a home equity line of credit can provide cash and some flexibility inside of your retirement plan for you to generate cash in the short term. And the final criteria is one called perpetuity. And this criteria is often less spoken about, but it's vitally important for retirees, especially retiree couples. And perpetuity is the measure of how an asset or investment or an income stream can survive the owner once the owner of that asset is no longer here. So in the case of a retiree couple, does that income stream or asset live to be passed along to the survivor or potentially down to the next generation or to another loved one? Stocks or bond funds would satisfy this criteria. Cash, things like life insurance, guaranteed income certificates would rank high in this category. They can be rolled over to a surviving spouse or passed down to beneficiaries through your estate. In some cases, they can bypass the estate via beneficiary designations that you have on something like retirement income funds, tax-free savings funds, LIFs, and other contracts that carry beneficiary designations. So now we're going to look at the 4 criteria and attributes in action. We're going to start with couple A. Both members of the couple have a defined benefit pension plan that are not indexed to inflation. They'll receive Canada Pension Plan and Old Age Security in retirement. Their projected income streams will just cover their planned retirement spending. They have very little in the way of other savings, and they rent their home. So in terms of ranking their plan based on the criteria that we talked about, I would say that their plan ranks high on certainty. It would rank medium on perpetuity, and it would probably rank low on flexibility and probability. So for this couple, they might consider focusing on building something like a war chest of cash and possibly a portfolio of equity funds and bond funds to help them build some protection against an unexpected expenditure, which would increase their flexibility, and also provide them with some additional protection against inflation or the rising costs over their retirement. So that would improve their probability score. So now let's look at couple B. Couple B owns a business and they've accumulated significant retirement assets both inside and outside the corporation. They have an investment portfolio of equity funds and bond funds. They have not consistently contributed to their Canada Pension Plan over the years, so they're expecting a slightly lower Canada Pension Plan income stream. They own their home outright, and when they plan to sell their business, they plan to sell their business in the next year. They expect that they're going to have enough money saved up that they can generate about 2/3 of their planned retirement spending from their equity and fixed income portfolio, and the rest is going to come from Canada Pension Plan and Old Age Security. So for ranking their plan, we would rank their plan high on probability, high on perpetuity. Their plan would rank low on certainty, and their plan would also rank low on flexibility. And while they can convert their stock and bond portfolios into cash quickly in emergency, if the need arose in mid-retirement and that coincided with a major market event, like a major market crash, you could argue that the income portfolio is not, in fact, that flexible. This couple might consider taking some of their savings and purchasing a life annuity, an income product that retirees can use. Annuities do serve a fantastic purpose in certain circumstances. They're going to give you that level of certainty in your retirement income plan for someone who needs it. This is a couple that I think might consider something like purchasing an annuity to help them with their retirement income. The other thing that they could consider doing is potentially delaying their Canada Pension Plan and Old Age Security to increase those future benefits for them. That would definitely increase their certainty score. So if you stayed watching this long, first of all, thanks for watching the video. If you liked it, consider giving it a thumbs up and leave any questions or comments below. The key takeaways are: number one, the perfect retirement portfolio doesn't exist in a vacuum. It has to be constructed for each retiree based on their own unique circumstances. Takeaway number two, I encourage you to look at your own retirement investment portfolio and hold it up next to your own other retirement income sources and figure out how well your overall income sources and portfolio for retirement rank against these four criteria. Number one, certainty. Number two, probability. Number three, flexibility. And number four, perpetuity. And finally, if you're unsure about how your overall retirement income plan stacks up against these criteria and you're looking for a second opinion, I've included some resources in the description below that should sort of help you moving forward with your retirement income planning. So again, thanks for watching this video. If you like it, give it a thumbs up, consider subscribing to the channel, and I'll speak with you in the next video. Take care.